All right, ladies and gentlemen, all that being said, let's jump into it. And we did kind of have a question that came in via email. Not really. At the end of the webinar, a survey appears. And survey says, rating of 1 to 5, 5 being the highest, 1 being the lowest. How would you rate today's presentation? Do you have any thoughts or comments on the material? Or do you have any questions you'd like to see Mike cover in a future webinar? So one of the ones that was answered related to what you'd like to see in a topic covered in another webinar came from Joseph from last week. And he says, how to handle in-the-money covered calls in covered call strategies. Fantastic. Well, we don't have a lot of slides or any slides really prepared for this. So what we're going to do is just navigate over to the PowerOptions suite of tools. As always, of course, we're going to use that for our illustrations on the different topics in mind. But what I'd like to do first, before we jump into PowerOptions, is I want to go over to the YouTube channel. So the PowerOptions YouTube channel, we've got several of our loyal subscribers, and we've got about 1,200, 1,300 videos there. But we also have this little thing called playlists. And our playlists are designed as about 12 to 15 different, there's about 12 different strategies, 10 different strategies, but 3 or 4 other discussions, earnings discussions, discussions on volatility, stock and market volatility as well, different strategies, about 9 to 10 videos in each one, walking through the basics of sort of step A through step Z, the introduction of the strategy, what you might want to consider looking for, criteria, comparisons of different structure in the strategies, and of course, many on the management techniques. So Joseph, when you have the time later on, go to the Covered Call Strategy Approach and Management, click View Full Playlist, and you'll see some presentations here. Calculating the best strike price for a covered call, finding weekly stocks, risks and rewards of weekly covered calls. And then we have a couple here on why use in-the-money covered calls. Starting off, why would I use an in-the-money covered call? I think your question, Joseph, is more related to, hey, I opened a position, I sold an out-of-the-money call because I thought I was getting a good premium. I wanted to continue the trade, but now the stock shifted up drastically, and now I'm in the money. And of course, you've got some other presentations related to that. Tools for rolling covered calls, triggers for rolling a covered call, criteria for the optimum time frame to roll a covered call, and covered call, take assignment or roll, and so forth. So there's a lot of ones there. There's even more, hey, if it goes the opposite direction, to roll or not to roll in the money covered calls, that relates to yours as well. These are short, 18 minutes, 17 minutes, 12 minutes, for example. Some of them are a little bit longer. But this will give you a basic guidance. Sometimes, of course, rolling a covered call that goes against you. I wanted to be assigned, but the stock fell. And now I'm in a position where I have to decide what I want to do next with the position. So, PowerOptions YouTube channel, click on playlists, go to the covered call playlist, check some of these out over the weekend, but we're going to discuss it right now, and this will be available over the weekend as well. So let's just go to PowerOptions. And we see here that we have some different movers. These are the ones that are the fusion trades at radioactivetrading.com, the married put positions. And MMYT looks great, up 6.1%, but of course it also fell about 12.5%, 13% recently this week as well. So we're going to go ahead and do that as well. What I want to do is let's take a look at the chart of MMYT. So we're going to go to charts, and we're going to go to big charts. And MMYT has been a big mover. I think the underlying security for us in the fusion by itself is up about 27 or 28% from where we got in. I think we got in around 60 or 61, had the ride up here to 90, and then it just plummeted. Wasn't related to earnings. I didn't see anything that came out on the news. Must have been just profit taking or maybe a lot of short selling. And you see here, usually when I've bought an extra put in my married put, the stock just dipped below the SMA 20. We had a negative MACD crossover, but today it jumped up almost 5 points. So I hesitated on buying that second put, that income method number 12 in the blueprint, once I saw my thresholds cross. So I'm going to see what next week brings us, but I'm in a good position with MMYT in a married put as it is. But let's say after I saw this drop, or maybe even a week ago, we can take either one, but I'm going to take around yesterday's time period. We're going to say that we bought the stock at around $75 per share sometime during the day, and we sold the right at the money 75 strike for whatever it was trading at. And now the stock has gapped up and we're trading at about 79. Okay, so that would now be an in-the-money covered call. We started with thinking the stock was going to hesitate, maybe settle, maybe condense, maybe stay around that 75 range, or hey, maybe a couple of weeks ago, we bought the stock here at 74 and we sold the 75 just out of the money call, and the stock rocketed up to here. Maybe what would we have done at that time? But we're going to take this example here, easier to do. How we find the prices that we need and the prices that we want. Well, let's just use the closing prices from yesterday. We'll take a look at the PowerOptions historical chain for MMYT. So we'll just type in MMYT up here at the top. I'm going to click on chain. Now we see here we're at 79.24, as I mentioned, close to 80. But let's go back to the previous day. We're at 74.65. Fantastic. That was the close. So let's use that price. So we bought 100 shares of MMYT, at 74.65. MMYT only offers standard expirations. There are no weeklies. So we're going to look at the June 21st, 29 days out, 75 strike call, just at the money, taking advantage of that at the money bell curve. We're going to sell the June 75 call for midpoint at 395 at yesterday's close. And of course, as we know, now the stock is trading at 79.24. So how would we handle that? First things first, let's go to the portfolio tools. I'm going to go into setup. We've got a variety of different, let's just stay in the, we only have 310 cash on hand on that account. So we're looking at 2024 covered call as a comparison to the previous presentation, Joseph. Let's just create a new one. We'll call it just ITM Covered Calls. I want manage. There we go. All right, and we know the stock price. So let's just put in 15,000. Copy that over. Say we started this portfolio on the 23rd. All right, looks good. Now that I've created a new portfolio, I'm going to go into the portfolio sub-tab here. And we're in our new portfolio we just created in the Money Covered Calls Manage. Let's enter our position. Now, I don't want to enter it as a long stock and then enter a separate short call. The portfolio won't link those together automatically. So what I want to do is enter it as a linked covered call position. Yesterday, we're going to enter shares of MMYT. We'll just do a simple 100 to keep the math simple. On or around near the close, I should say, Joseph, we got in at 74.65, no commissions to keep it simple. We sold our June 75 call for a premium of 395. That was the midpoint at the close. And now we're set. Let's go ahead and submit that as our covered call position. Now we have one covered call, the MMYT, opened at 74.64. It's up 459 to 79.24. We sold the call for 395. The call moved up to 65. So now the buyback cost is 660. Now we still have 28 days to go to expiration. Note here real quick that I've selected the tab for stock analysis. When you first go into a portfolio, it might show you the standard view. Well, this is good. It shows you each individual leg, your original issue price, the effective cost per share in your stock. That comes important when you start rolling and closing positions. The effective cost per share will adjust. Current price and change today, gain and loss on the individual stock and on the individual option based on its initial price. Well, it cost me $265 more to buy it back for selling at $395, so we're down 67%. The reason I prefer for spreads, covered calls, married puts, collars, linked positions, the stock analysis view is it gives us these 6 extra columns with the total position cost, the cost of the stock for 100 shares minus the premium, the original expected profit if assigned at expiration, the max profit in this case with a covered call, my current liquidation value using the midpoint of the option and the current price of the stock, and my current liquidation monetary gain and percentage gain. I expected a 6.1% return if assigned. And now I'm at a 2.7% if I liquidate, and if I hold it for 28 days, I'll make 6.7%, another 3.4%. My apologies. Math is hard on Fridays. 3.4% extra return if I leave it to expiration, We're not projecting where the stock's going to be. We're just saying that if the stock stays where it is right now at 79.24, 28 days from now on June 21st, we'd be assigned, make our 6.1%. Okay? Now, on those webinars I showed you, we break down the different ones. Why using the money covered calls? What covered calls could I have selected with MMYT yesterday? Let's go back to that chain. And we'll go back to the previous day. And we're just going to look at calls. And so when I'm comparing covered call positions, potential covered call positions, Joseph, one stock at a time, I prefer to use the option chain. And this shows me the important information that I'd use for a covered call. These shaded ones, I added the annualized in here, but the shaded ones here, the downside protection. The option premium divided by the stock price at the time you open the trade. What it's showing you there is how far the stock can drop before you're technically losing money on the position. The percent if unchanged, if the stock stays at the same price, highly unlikely in these markets over the next 20, 30, even 7 days with a weekly option, what would your return be? And then, of course, the percent if assigned. If the stock is above my strike price at my expiration date, what is my max return I expected? I've added the columns for range in the money and probability. Now, we focused on the at the money 75 that has the highest time value at the time of 395. This was yesterday's close, remember, at 74.65. So the 70 strike at 690 was 465 in the money. So the time value with the price at 695 was only about $2.25. It's less than 395. This is the at the money bell curve. You always see the highest time value at the money. And then the out of the money options and the in the money options have a lower time premium. Or you could look at it in this fashion, where you're right here at 75, that's the time value swell. So that's where we sold. But comparing the different positions, of course, just going back one step, why would I even use an in the money cover call? Why would I sell the 65 strike at this time when the stock was at 74.65? Well, I might not have, honestly, but I'm getting a premium of 1070. I have a 14% downside protection, meaning the stock can drop 14%. Before I'm losing money on the position. My max return, if the stock stays above that 65, is only 1.6%, but I have roughly an 85% probability that in roughly 30 days, I would have made that 1.6%. It's all trade-off. Higher probability with an in-the-money covered call, lower return, but better downside protection. The 70 strike, still pretty good for an in the money, a 9% downside protection with a midpoint price of 690, and still a 3.3% if assigned if the stock had stayed above 70 to June expiration with a 68.4% probability. But based on your question, how to handle in the money calls and covered calls, Joseph, meaning that I think you sold an out of the money call, maybe the 75, maybe the 80, but now the stock has moved up and your position is in the money. Hey, we were looking at a 6.1% return if assigned with a 48% probability, but only a 5.3 downside protection. The 80 still offered 215 in premium. That's only a 2.9 or roughly a 3% downside protection. But if we let ourselves get assigned at 80, it'd be a 10.3% return. Because why? We'd get the additional $5.35 in intrinsic gain plus the 215. There's only a 30.3% chance probability. Now that the stock's at 79.65, I bet that probability is a little bit higher. But this is sort of the construct of the structure. A lot of investors like to buy stocks that they want to hold long term, sell out of the money covered calls with that lower probability, that 0.3 delta, 30% probability, and just generate that maybe 2.5, 3% return per month, maybe 0.4, 0.5% return per week, and not be assigned. But we did a different situation. We did do the just at the money covered call with MMYT, and now we're in the money by almost a full strike. How are we going to handle that? And that's what the Power Options tools help us with the management, rollout opportunities, and more. One quick side note here, what I first would have done if I would have opened MMYT in this fashion, using an at or just out of the money covered call. and I want to be notified if the stock went above my strike price, or maybe went above 1 or 2 points above my strike price that I sold, or if the stock changed direction related to a simple moving average, 50-day moving average, 20-day moving average. Well, let's take a look. Here in the portfolio, we have the alerts column. So when I entered this trade, I would have set various alerts. I want to be notified. Remember, we sold the 75 strike, that maybe if the stock hits 76.50 or $77, and to me, that's a red warning. I'm going to look to roll the position up, adjust the position if possible. So I can put it there. We can put, if I'm within 5 days to expiration, or if the delta that hits a certain level, or if it goes more than 2% in the money. For example, the option percent in the money limit. I might enter that as well. If I wanted this to stay out of the money, Joseph, and I'm looking to have it just expire worthless, in this case, and go that route. Of course, and if the stock, you originally would have opened the covered call, maybe the stock was above the 20-day moving average, the 50-day moving average in an uptrend. So you might want to set alert if the stock changes direction, is below the SMA 20, or if I'm within 4 days until earnings, for example. Things of that nature for a longer term play. Now let's go ahead and save those alerts. And now we see that alert's been triggered. Well, we know one alert's been triggered. The stock's above 76.50. So when I go into my portfolio, I have my 10, 12, 15 positions open. I can immediately see if any of the alerts have been hit. Which alert was hit? I'll go into view. Yep, the stock is above 76.50, and I'm now 5.4% in the money, and I wanted to be notified when I was just 2% in the money. All right, so it gapped up today. Have to handle this. How am I going to handle? Sorry, folks. How am I going to handle this? Well, now that my alert's been triggered, what we do, Joseph, in the PowerOptions Portfolio tools, whether you're tracking covered calls, cash secured naked puts, married puts, even just long calls or long puts, credit spreads or calendar spreads, I'm going to click the Edit More Information button next to the position. We are going to go to Position Actions and then select Position Analysis. Now, this gives me a breakdown of my current covered call for MMYT. And we know our specifics. We sold the June 75 call yesterday for $3.95. That put our break even at 70.70. We had that good 5.3% downside protection. My delta has moved up to 0.7. I still have 3% time value remaining in this price and 28 days to expiration, a basic profit and loss chart of what we're looking at right now. Now down below, I can see more details into what we just saw by selecting that stock analysis view in the portfolio. The original position value, 70.70, my max expected return, original expected return of 6.1% if the stock is above 75 at expiration. Current liquidation value, we saw that too, make a profit of 194 after 1 day or 2.7%. Buy back the call, sell to close the stock, we make 2.7% in 1 day with this movement. But that's 45.1%, the max expected profit of 6.1%. And down below, of course, if the stock stays at the current price or above 75, we'll make the full 6.1%. We collected $3.95, we know that. We see the buyback cost here at $6.60, so we're down about $2.65. But down below, you're going to see the potential for rollout opportunities where we're going to do the math for you. What are we seeing here? We originally collected $3.95, as we know. It's going to cost me $6.60 to buy back this position. If I want to roll this covered call, stay out of the money, because I want to hold this longer term, or I'm expecting more growth. And so what do we see? Well, I could roll to the June 80 call. We collected $3.95. The June 80 call, the next strike up, is at $3.80. And then we'd have to buy this back at $6.60. So the adjusted net credit we'd get for this transaction is only $115. Rolling up to the 80 would only leave us with a 1.5% downside protection. And the stock could fall 1.5% from where it is now before we start losing money on this position that we actually have a profit on, due to the extra cost of buying it back at $6.60. However, if we do get assigned at 80 now, we'd increase our potential max return by 2.7%. And these are still rolling for a credit because it's taking into account that $395 and the new credit of $380 and then the buyback cost. But if we wanted to be a little bit safer, we might have to roll further out in time. We could roll to the July 80 call, but that's essentially what? That's right at the money right now. At least I'm keeping an at the money bell curve by selling the next at the money strike at 80 for the next series out, but that's 56 days away. We'd get a new premium of $545, so we'd have a total adjusted credit, $395 in, new credit in of $545 minus our $660 buyback cost. Still have a good 3.8% downside protection and a potential 11.3% return if we're assigned at 80, 56 days away. Not quite double it, but we move it up 5.2% to this next level. If we roll to the 85 to June, July, for a little bit more upside movement, we're only going to keep an 80-cent net credit because we're only going to take back in $345. Now we only have a 1.1% downside protection, but a potential 15.1% return if we're assigned at 85, if we allow that to happen in 56 days. So now your comparison starts, excuse me, Joseph, now your comparison starts to come. What is my original target or goals in my portfolio for these covered call positions? When you initially sold this call, you took in $395. We saw we had about a 5.3% downside protection or premium against the stock. Rolling up to these new strike prices, I'm not keeping that. In other words, I'm not going up to a 10% downside protection or a 10% against the stock. It's lowering. I don't see that anywhere except for with the August 75 moving from 5.3 up to 9.8% for a new adjusted net credit of 730. But now for 84 days out in time, the max return if I'm assigned is only 11.4%. Does that match my trading goals? That's the next step. What was the original target I was looking for a potential max return on this position in 7, 14, 20 days, depending if you're doing weeklies or monthlies or 2-week out options, whatever your preference is. But you've got a goal in mind. That's why you're trading. You've got goals of what this strategy wants to do in your portfolio. You want to see this strategy do in your portfolio, Joseph. So now we know where we stand. A liquidation after 1 day of 2.7%. I can make 6.1% if assigned. Here are the rollout opportunities I have. I can go to higher strike prices and increase the return for an additional 30, 28 days, from 28 days to 56 days. That probably does meet my premium goals. I am still at a positive net credit in these rolls that we're seeing here. Some of them aren't, and I don't really want to roll for a debit if I can avoid it. But is it worth going now 84 days out? And sometimes you might even see ones that are 120, 110 days out in time. Is it worth it to roll that far out? Depending on what your targets were. Is a 22.3% gain in 84 days going to meet your goals? It probably would, to be honest with you. We're talking 3 months out in time. That's 7% per month. We'd all take that readily every time if we could. But what's the trade-off? You only have 1.4% of positive downside protection because your total adjusted net credit is only down to 105 or 260. That's where you want to evaluate what is the point of the roll. Do I want to stay in the position longer term? Do I not want to be assigned maybe for tax purposes? It's not in a tax sheltered account. You bought Apple maybe, or you have a cost base on Apple of, let's say, $98, and you're about to get assigned on a call on 5,000 shares, and you don't want that to happen for the tax implications. Track the position in the portfolio, Joseph. Link to that position analysis tool, and you'll see the rollout opportunities. Now, taking this one here, going up to the next strike, taking advantage of the at-the-money bell curve, buying back our June 75 that's now in the money, rolling to the July 80, which is 28 days further out in time, but is now essentially right at the money. So we're getting the highest time value possible for the July series at this time with the 80 strike. Well, it's great to see things numerically. Hey, I've got a 3.8% downside protection still. I've got the potential of 11.3% max return if I'm assigned at 80. But sometimes seeing it numerically might not suit your needs. So we want to link from this potential rollout opportunity to simulate trade. Simulate Trade tool will give you a side-by-side comparison of your current position on the left in red. Again, where we stand right now with our liquidation and current return, and of course the max return we might expect, remember, in 28 days, if MMYT stays above $75 per share. That's 6.1%. Going out to our July 80 call, we took in $395, paying $660 to buy it back, getting a new premium of $545. For that adjusted net credit we saw, new effective cost per share of $77.30, but the potential of being assigned at 80, well, our new max profit here is going to be $815 or 11.3%. And down below, you can see the side-by-side comparison. Over on the left here, my current position on MMYT, one strike roughly in the money. As to rolling it to the just at or slightly out of the money position, at the 80 strike, a little bit more upside. If this call expires, we keep the full 545. We lower that cost basis back down to that 71.85 area. And we maybe at that time in July, remember it's 56 days away, depending on where the stock is, we could sell the 85 and collect another $2 for August, or maybe the 80, depending on where the stock is, collect another $4 for August, and continue this trend of being out of the money. As you can see here, though, there's nothing wrong with being assigned, and there's nothing wrong with taking a 2.7% return if you liquidate right now in one day. Are you going to be able to duplicate that every day? Not really. I took a specific example where yesterday looked like a strong stock that had a pullback. Probably not one we'd enter because it was trading below the 20-day moving average and we saw the negative MACD crossover. But at the same time, this illustrates what you might want to consider doing when you had a just at or out of the money call that you initially entered. The stock is now moved above, had a sudden movement. We're going to track the position. We're going to compare our max return to our current liquidation gain or loss. We're going to set our alerts. And when our alerts are triggered, we're going to go to that position actions again, remember, and then position analysis. We're going to review our rollout opportunities. What is it that I'm giving up by staying where I am right now versus rolling to these positions further out in time? What am I gaining? What am I giving up as far as downside protection? Is it worth it for me, or should I just leave it open right now? That, again, Joseph, is going to come down to your initial plan for the stock that you're in. If you're not wanting to be assigned, because as I mentioned, it might be a stock that you have a very low cost basis on, you're in a non-tax sheltered account, you don't want to be assigned due to the tax implications, you want to hold the stock longer term to continue to sell at or out of the money calls against it to collect a dividend-like income on a regular basis. But that's why we have these power options tools. That's why we have the rollout opportunities to help you mathematically analyze that for you. What are the opportunities that are available? What are you giving up as far as potential return, potential downside protection? And do the new returns that you see meet your targets for the position, your targets for the premium and adjusted net credit, going out another 28 days, going out another 60 days, so on and so forth. You're able to see those opportunities here. And then, once again, you compare them side by side by going to the Simulate Trade feature to see your before and after picture of your current covered call position versus the new position that would be available. And if this is a role that you decided to do, well, to enter it in the portfolio, you could simply scroll down here, put in your commission fees, put in your prices, submit change to portfolio, and then that would be recorded for you that you bought to close the 75 call for June, roll to the July 80 call. And that would be tracked now in the portfolio. You'd be able to see the history when you go to the rollout opportunities. You'd see the history down here of any adjustments. And you'd also be able to view the history in the analysis by symbol or analysis by position if the roll was completed or dividends were entered or any other longs. Okay? So, Joseph, that's how we handle in the money covered calls. In addition to this discussion, which will be posted likely tomorrow or possibly sometime on Sunday. Remember, check out the YouTube channel on Power Options. Go to the playlist, go to the covered call playlists. Why use in the money covered calls? More importantly, I think for you, triggers for rolling a covered call, take assignment or roll, to roll or not to roll in the money covered calls. I think these are where you would want to go in that fashion. Okay? And that'll help illustrate further your question related to in the money covered calls, why we would use in the money covered calls at the start to begin with, and how to handle those covered calls as well. During this start of this conversation, Richard says, how do I get into the trade simulator for options and utilize the information provided there? And Richard says, answered, because we just walked through the rollout opportunities and the simulate trade feature. And again, you'll see that with other strategies as well. Let's go back to our portfolio. And let's say that same time, remember, we were looking at Make My Trip and we saw this pullback. We said, ooh, this is looking good. This is looking good. It's down at 74. We probably wouldn't have done the 75.80, but we're seeing these trends change. We're seeing a MACD crossover. We're seeing it gap below the SMA 20, not gap, but we're seeing it drop below the SMA 20 yesterday. I might have said, ooh, now is a good time for a bear call credit spread. So let's go back to our MMYT chain. And let's say that yesterday at 74.65, I went ahead and sold the 80 call for June at 215 on May 23rd. And we bought the 85 at 158. Now, would this have matched me? No, this is only a 70% probability. So I would have been forced to go here, selling the 85 at 158 and buying the 90 at 55. That would have been my spread with the 84, close to 85% theoretical. Okay, 83.4% theoretical probability. But as an exercise, let's go ahead and enter a bear call credit spread for MMYT. And we're just going to do one contract. And let's go ahead and what do we do? We're buying the 85. That's right. We're buying the 85 strike for June. We're going to do one contract. And of course, we did it yesterday when the stock was at 74.65. I apologize. 74.65, I think it was. And our premium to buy that option was 158. And we're going to sell the 80 strike. Sold one, and our premium at that time was 215. And naturally, this is only about a 70% probability below, so I probably wouldn't have chose this one anyway. I would have gone with that higher 83, 84% probability, selling the 85 and buying the 90. But let's just use this example. I entered my bear call spread. As before, I would have likely set alerts that if the stock's within 1% of my short call strike price, which it is right now, if it was at 79.20, I want to be notified. It hit that mark. Or if my liquidation value was half of the maximum risk. What was my maximum risk? In this case, we took it up. I entered that completely wrong, didn't I? Let me go back. I think I entered that wrong. That's why that return is showing all wonky. I think I put something in the wrong placeholder there. Let's edit the position. Commission fee. No commissions. Sorry. Stock price at time of trade. That's where I wanted to enter. See, even I get confused, guys. I'm sorry. That's where we want it. 70. That's why the returns look so off, because of the commission. But that was the stock price at time of trade. Let's try that again. Get a better view of what we're looking at. Perfect. Okay. We took in a net credit of 57 cents. And that means that our max loss on this position would have been about 443. So we're at a liquidation loss of 128. I'm not at the halfway point yet, but I am within 1% of my short call strike price. Excuse me. You can see these triggers that we use in our credit spread playlist as well. I would have set that alert to 1% of the 80 strike would be if the stock was at 79.20. So that's what I would have entered here, upper limit of 79.20, and that's a red warning for me. And of course, the not that one. Where's the position? Position percent change. If I'm down 50%, I would have put that in as well. All right. Now let's just go ahead and save the alerts. And as with our covered call example that we just saw, now my bear call credit spread has triggered an alert. We know which one it is. The stock's above 79.20. That was my upper stop limit. So I'm going to use that more information button, go to position actions, and then position analysis. I might not see any rollout opportunities on this one because it's still 28 days remaining, but we might see something down here. Here we go. So what this one gives us is an opportunity to not change, but leave our position as is, our bear call credit spread, but to get a little bit extra premium. In this case, A little bit, not as much as I would have hoped for. I might have wanted to go with a 70 and 65 in this case for a little bit more oomph, but it's giving us another 23-cent net credit to increase the upper break even and the lower break even. By adding a bull put credit spread, we're going to create an iron condor. And again, so the new max risk drops down to 478 on the spread. It is a 5-point spread as well. And let's just take a look. Again, it's great to see things numerically. I want to see things graphically. Go to simulate trade. My original position here, we're down about 30%, 12.9%, good, decent return. That's usually what I target for around a 14-day trade or 2-week day out trade, credit spread wise, instead of a monthly. And of course, now it gives me the new position, a new net credit of 80 cents. I'd probably want higher. And let me see here what the comparison would be. So we're going to increase the upper break even, my apologies, from 80.57 to only 80.79. I'd probably use the closer strikes of 70 and 65, to be honest with you, as a repair. And look to see why that didn't come in. Talk with the programmers potentially over the weekend, but at least on Monday, saying, hey, why didn't I see more Condor rollout opportunities? What was hindering that here with the 70 and the 65, which I think might have been a better repair. But when the stock goes above the strike price, in this case the bear call, or below the strike price in the bull put, you might see other rollout opportunities that I wouldn't consider right now because the short call in our case is not yet in the money. We're still out of the money, though we are very close. We're in our 1% rule. But you'll see some rollout opportunities here as well. And of course, if I had entered this as a married put, and now the stock is at or near my strike price of 80, if I bought the stock at 74.65, bought the 80 strike put probably out to November if it was available, maybe a little bit further, then yes, in that case, I'd see rollout opportunities for the married put trade as well. So again, tracking the positions, set your alerts in the portfolio, position actions. From the more information button, position analysis, evaluate your rollout opportunities, see what meets your goals based on your targets that you've set for the position.